welcome everybody to our first meeting, and welcome to the Speakeasy Jade Lizard Room. This room, or these first strategies, are all a combination of 1 or 2 leg option strategies. Today we're going to just be introducing long calls, and we will be looking at conceptualizing what is on the option chain, so that as you're considering purchasing or selling options contracts, you have all of the information there in front of you. If this is your first time that you are, looking at options or buying or selling options, and this is all brand new to you, please don't feel overwhelmed in the beginning. All of this is kind of a new language. And as you go through the strategies and you listen to the presentations and even review these first presentations, you will find that the language becomes a lot more natural. So don't feel overwhelmed right at the beginning, because we will be talking about the mathematical structure of how options gain or lose value. And it is really important to understand the structure of options so that you understand how the pieces are actually making money. And oftentimes people quasi understand what's happening with options, but they don't understand some of the smaller details. And so they end up being minimally profitable, or sometimes even losing money, even though the price of the underlying that they're looking at, the price of the stock, is going up or going down as they anticipated, but their options contract is not reflecting that movement, and they're not exactly sure why. So hopefully we will just get some cursory details about the options contract and just how to set up the most essential and kind of the basic structure, which are long calls.
But before we get started, the disclaimer. You have to trade responsibly. Past performance, whether actual or indicated by historical tests of strategies, is no guarantee of future performance or success. There is a possibility that you may sustain a loss equal to or greater than the investment, regardless of which asset class you trade. Therefore, you should not invest or risk money that you cannot afford to lose. Options trading is not suitable for all investors. And again, these videos are for educational purposes only. You must do your own due diligence and research before setting up any of these strategies in your live account. But please do practice them in your sim account immediately so that you can start to get used to how each of these strategies work as there are changes in the market throughout the day.
With long calls, what you are doing is, in the option chain, you will buy to open a call based on either your technical thesis or some kind of analysis that gives you the sense that the price of whatever underlying you're looking at is going to be bullish. It is going to go up. The price is going to increase in value. And you believe that that price is going to increase substantially. You are also expecting a rise in volatility. It is very difficult if you enter a long position when volatility is very high, because once volatility starts to drop, it does shift the dynamics of the option value. And we will talk about that as we go on. You want to be looking for a market catalyst. Maybe there's earnings coming out. Maybe there's some positive news. Maybe there's a release of a new product for the company, or a merger or an acquisition. And that gives you this sense that there is going to be some positive attention or a positive move surrounding that underlying. And of course, having your technical bias, and then believing that that move is going to be significant. So this catalyst can be really anything that you believe will drastically change the price, will increase the value of the underlying. And your technical bias could be based on chart patterns or indicators, or a combination of the two. So the options contract, which often people get confused about because you're not actually buying the underlying thing, the underlying stock or index. You're buying a contract, and that contract gives you the right to buy whatever the underlying is that you're looking at, to buy 100 shares of the selected underlying at the strike price that you choose anytime before the market closes on expiration. So when we say the right to buy, you are essentially entering a contract where you are telling the broker that you would like to buy, let's say anything you want to buy Apple at $120. And because you believe that in the coming months, Apple is going to shoot up to 170, and the broker does his analysis and he says, okay, I'm willing to charge you X amount of money in order to hold that contract. And so anytime between now and the date that you agree for the expiration, you have the right to buy Apple at the $120 that you secured in your contract. So you have essentially gone into the dynamic like with this strategy that you believe that price is going to increase of the underlying. And so you are going to take what we often call a profit trigger. So you're just looking for a move of the underlying at a certain dollar amount. And once it reaches that dollar amount, then you exit your strategy before you believe that price maybe is going to retrace, or price is no longer bullish, it's starting to be flat, or that volume is starting to drop, or some other kind of technical gives you the indication that price is no longer moving up. And so you want to exit your call for a profit. So you will sell to close your call for your profit trigger. Now, let's say, for instance, you were in Facebook and this horrible news came out, and yesterday the stock price was tanking, and so you have to also have in your trading plan an exit strategy. So what percentage am I willing to lose, or am I able to lose where it doesn't affect my entire portfolio and my account? Because once you start capitalizing losses or crystallizing losses, and you start shrinking your account size, in order to overcome those losses, you almost have to make double the amount of money in order to make up for the loss with a smaller account. So that's why you want to have in your trading plan some kind of exit strategy if your thesis was incorrect about the stock, or it has been bullish, but maybe it's just not moving fast enough for your option contract to also increase in value. So again, the option contract stipulates which party has the right or the obligation to buy or sell. So in long calls, you will be the buyer, and whoever is on the other side of the contract is selling that right to you. And at an agreed price, which is the strike price, before a specific time. So that is your days till expiration. An option, again, is a leverage token. So it's kind of like wholesaling, and you are agreeing contracts of what is going to be the buy and the sell price. You are not actually looking to buy the thing. You are just, you may want to buy the shares, but essentially the contract, you're trying to move the contract around so that you are capturing that profitability as the underlying moves. And it's leveraged because the contract gives you kind of exposure to 100 shares of the underlying. So it doesn't cost as much to get in because you would only be in that contract for a window of time. Unlike the shares, which you could hold for the rest of your life, you could give them to your great grandchildren if you wanted to. So the options contract and the pricing of the options is based on a mathematical formula. And so you have to understand those different pieces in order to understand how the price has been calculated. So you know what you're buying, so that you understand what it is that you are going to try to sell for your profit later. And options give people with a smaller account exposure to underlyings that are maybe too expensive for them. So things like Google or Amazon or Shopify that are, up in the thousands of dollars, and you might not be able to buy 100 shares of Amazon, but you may be able to afford a contract, which just gives you that exposure for a smaller window of time. And as we move on in the different strategies and we start to get into the multi-leg strategies, you will see that there are some traders that actually focus purely on scalping, volatility, and gamma, and even some of the other options Greeks. So we will talk about all of this in advance, but as we go on, but not all options traders are actually trading just the price of the underlying. Sometimes they're looking at other aspects of the contract. And that's why it's important to know, because sometimes you may not be able to make money on the price movement of the underlying, but you may actually be able to make money from a change in volatility or a change in gamma. And that all comes with experience as you start to understand the pieces of the options contracts and the Greeks. So essentially, a long call, again, is just you are profiting from the movement of the underlying that during the time that you are in that position. If the price just remains flat, it doesn't actually increase, or the price drops, you will actually start to capitalize a loss. And if you don't exit before the expiration, then you could end up losing all of the money you invested if price does not move far enough along. So we will look at some different ways that you can calculate what your potential profit would be, so that you have a reasonable expectation of what could happen and how you might be able to make money in a movement, and how much money you will be able to make, because oftentimes people confuse that. So again, because you are paying to get into this position, it is possible to lose all of the money if the price doesn't make a move and you don't exit the strategy. And oftentimes when you see people reference the break even of a long call, actually what they're trying to calculate is based, if I wanted to buy, let's say, Apple at 120, and I paid, let's say, $1,000 to get into that. So it would be that I paid $10 for that contract. And the price of Apple would need to move $10, the amount that I paid, in order for me to break even if I decided to buy the shares of the underlying. Now, most people with smaller accounts don't have the intent of actually buying shares. But if you were trying to buy shares, then you would need the underlying to make an outsized move of both your strike price plus the premium that you paid to get in. And again, we will see that as we go on, we'll continue to talk about that. But if all you're aiming to do is scalp, then all you need price to do is just to make that bullish move. And the more efficiently it does that, the better your options contract will do. So these are the Greeks. And again, we don't always talk about them very often, but when you are getting into a contract, you do want price to make this significant move, but you want to make sure that you have enough time in your contract so that theta, which is time, is not squeezing you. So if you believe that Apple is going to make a $10 move in 2 or 3 weeks, you don't want to have a contract that's only 1 week, because obviously it's not going to make that $10 move within the amount of time that you have given your contract. So you want to make sure that you have enough time that is relevant to the move that you are expecting, or the move that you are hoping for. And it is better when price is moving efficiently. So if you are working with if you are looking at an underlying that has very low volume, then what can end up happening is that every time volume drops, the price will, kind of go up and then be flat and go up and be flat. And that can actually be really difficult on your option contract, because all of those, that's considered a part of volatility, the speed of the move. That when the option contract is not moving quickly, all of these volatilities here start to drag down. And so it's like the time is dragging down, the volatilities are dragging down, and those are like pulling against the positive movement of your underlying. So you want to make sure that you are actually giving yourself enough time for the price to do what it wants, but also that price will move efficiently. And that just takes time to get used to. Pick a couple of stocks that you love and watch how they move. Some of them are great. They move efficiently throughout the day, and that's awesome. Then you'll have other stocks that don't have the sufficient volume, and so they just are constantly up and down, and not necessarily up and down in that they have big price swings, but that they're just not moving efficiently in a bullish way. And so this causes the volatility aspect of your option contract to constantly be dragging you down. So with long calls, you obviously are, as we've said, you're buying to open. So you are paying to get into this position. And so you need to have a strategy of when or how you want to enter this long call. And so good market dynamics at entry is, like we already said, is giving yourself enough time to buy when volatility is low, so that you are not overpaying for volatility, and that when volatility increases, and there are multiple volatilities, as we saw in the previous slide. You have the volatility that's in the market generally, and that is implied volatility. Then you have what is the volatility between the different pieces of the option chain. So when those pieces are moving quickly, because time is moving quickly, sorry, not time, but price is moving quickly, then you start to benefit from the increase of Vega, which is another volatility that's inside the option chain. So you want to buy when volatility is low, and we will talk about how to analyze that. And then you want to take advantage of that increase in volatility in the market generally, or with that particular underlying. Usually in the afternoon, volatility starts to drop. So after 11 p.m., you will, at 11 Eastern Standard Time, so a couple hours after the market has been open, you will start to see that volatility starts to flatten out. And that's because there tends to be a reduction in volume, because most major hedge funds or banks, they usually have all of their orders in from the night before. So you will often see a lot of volume start to come into the market from actually 8 a.m. Eastern Standard Time. And then you'll start to see the volume really, burst in that first 30-minute, 1 hour, momentum candle of the morning. So if you're looking to get a long call that is maybe like an entire year, so you're actually trying to get a leap, then I would never advise you to do that right away at the morning. Do that later on in the day when volatility has dropped and is a bit lower. Usually Tuesdays are turnaround Tuesdays. That's Tuesdays usually when the market is actually really quiet. This Tuesday is completely has surprised us, but that's also because of everything that's happening in the news and the good news with oil yesterday, and just having that big bearish move throughout the market yesterday that gave us a bit of consolidation for this strong bullish move today. But normally Tuesday is actually, I don't want to say a bearish day, but usually you will see underlyings take back some of their gains from the Friday and the bullish Friday and Monday, which sees a lot of volume in the market. So again, you want to know what your earnings calendar is looking like. So usually about 6 weeks before a stock or a company's having their earnings reports come out, that's when volatility starts to climb. So if you are in that quote unquote volatility window, you should try and plan to get your long call before that volatility already starts to increase. That way you can benefit from the explosion of volatility that happens leading up to earnings. But if you are uncertain of what might happen after earnings, then you want to close that position, because usually after earnings, there is a big volatility drop. And you can look at things like the implied volatility rank and historical volatility. So you can see if, for whatever reason, a stock happens to be unseasonably high, you wouldn't want to buy right then. You would want to buy when an underlying is unseasonably low, as long as that's not based on some problem with the underlying, then you don't want to do that. So here's our beautiful option chain. You will find it on, if you go to your Thinkorswim platform, you will find this on the option tab, on the trade tab, sorry. And here you will find on the third rung option chain. And because we were talking about the Greeks, I do have my option chain set up to show us the different Greeks. So as we already talked about delta, we haven't talked about delta yet. So we will talk about delta and gamma. Theta is time and vega is volatility. So these are, you can just start to see where that information is on your option chain. Normally, the layout of your option chain does not include these. So you would have to actually change it to include them. And I do think, especially when you're starting out, it is important to keep these kind of like there so that you can start to learn and get a feel for how the different Greeks are moving as your option is approaching its expiration. Another thing that you will find on your option chain sometimes is this thing called the MMM, and that is the market maker move. So based on whatever has been happening in the pre-market, you will get this kind of this signal if the market maker or the broker believes that there is going to be an outsized move from the underlying that day, or there's going to be an undersized move during the day in relationship to implied volatility and the implied move. So on your option chain on the right side, you will find here implied volatility, which is historical. It's a historical volatility and the volatility that's in the market. And then that will give you the implied move. And that is what the market maker believes, that between now and the particular expiration date, the underlying will likely move this many dollars up or down. And so this gives you the information that you need about your long call. If you are expecting there to be a $50 move and on Microsoft, but the option chain is telling you no by the 27th of August, this is obviously an older picture that I pulled off my option chain, that it's only going to be a $17 move. So then you realize, oh, my expectations are actually a bit are a bit off because the market maker is not seeing that it's going to make such an outsized move. Now, for whatever reason, you may have like some conviction as to why you believe it's going to move $50, but it is good to be aware of what the broker thinks, because the broker is going to determine how much risk you are taking on, depending on the position that you're getting in. So if you are taking on a position where you believe that the price of the underlying is going to move $50, well, then you're not going to pay a lot of money for it because you're taking on a lot of risk, and the broker doesn't actually believe that's going to happen. So he's going to let you spend your money because he thinks what you're doing is nonsense, but he's not going to take a lot of money from you to do it. He's just going to let you kind of gamble, and because that's your prerogative. But it is important to see what the broker believes is going to happen, because they have a lot of information that we don't have access to. Something like order flows. The broker and market makers, they can see all of the order flows that are coming in and out. And that's how they're determining a lot of how much volatility they think is going to be in the market that day, based on how much movement there is. And we can't see all of those order flows because we just don't have, we are not privileged to all of that data. So sometimes it is important to see what the broker is saying, because they do have more information than we do. So up at the top, like I said, I've had my layout set so that I have the Greeks in my option chain. And as you can see here, we have the delta, we have gamma, we have theta and vega. So I will explain these also further in detail, but they're really important when you are setting up your option contract. So when you are, so you've done your analysis, you've decided to get into this underlying, you believe that the underlying is going to move enough that you are going to be able to be profitable. And so now you are deciding, setting up your close. So you're going to exit this strategy because now you are in a profitable position, or potentially going to be in a profitable position. So you should already have in your trade management plan what your profit trigger is. And the profit trigger is basically either a dollar amount or a percentage of profit that you have attained, and then you buy to close your structure for that move. The other thing is that some people will, because they're using different indicators to determine when they want to enter, when those indicators start to shift, then they may decide that they should exit their strategy because the environment has changed. So a lot of people will look at support and resistance. They will plot out their support and resistance lines. And so as they see that price is moving away from support, but it's about to hit a very strong resistance level, then they might decide to close the structure, or at least they will watch to see if price moves past that resistance area. The other thing is that some people like to use moving averages. And so as long as the moving averages are what we call stacked positive, so it is showing that the price is efficiently moving in a positive direction. So the smaller moving averages like the 9, 15, 21, 34, different traders like to use different EMAs, but as long as they're stacked positively, so from the smallest to the largest moving average, and price is then they believe that price is still giving them a bullish signal, and they will remain in that trend. But if those EMAs start to cross, then that is showing them a potential bearish moment, or a drop in the price, or a flatness in the price movement. And so then they will exit the call, because it is just not, there's no more value in the movement, because price is no longer moving up efficiently. Or let's say that you are in the contract and about half the time has passed. So you've bought a 2-month contract and you're nearing like 2-3 weeks into the contract. And though price has moved up, it hasn't moved up a lot. And so you are losing that time value that you paid for. And so at that point, it makes sense to exit that position, because unless you have a really strong reason to believe that price is going to make a sudden big move in the end of that contract for whatever reason, you are losing value that is part of that contract, because you paid for time and now you're losing time and the underlying isn't doing what you expected. So before you lose all that time value, you can close your structure and reposition yourself, position yourself in a different stock or equity or ETF or index, but make sure that you're not just like riding on hope that something is going to happen. You really need, especially if you're nearing that halfway point in the contract and the underlying hasn't done what you expected it to do, then you really do need to have a strong thesis as to why you are still hanging on. There has to be strong indicators or other charting patterns that are giving you a really strong signal to hold on, but it should not just be because you believe in the underlying. That's by itself, that's not a good enough strategy. That works when you own the stock and you believe like 10 years from now it's going to be more valuable than it is today. But when you are dealing with contracts, you want to make sure that you are opening and closing them in an efficient way. And so you don't want to just be like losing all of the premium that you paid out to get into this position. So one of the things I did not talk about is the delta yet, and that is one of the most important aspects of the contract. So I'm actually going to go back to our screen. So as you can see here, okay, at this particular time that I took the picture of the option chain, Microsoft was trading at 289. So the blue side, the blue shaded area of the option chain is all the values that are less than the current value of the stock. So $280, 270 is obviously lower than what the current value is. And if you were to create a contract based on these values, you're asking the broker to give you a contract to sell you, to give you the right to buy Microsoft at $270. That would be considered in the money, because it is a value that is lower than the current value, which would be a benefit to you. Like if you could buy something at $15 or $20 or $30 below the current value, that would obviously be in your favor. And if you were able to do that, but it does come with a caveat that the deeper in the money you go, the more expensive the contract gets. And so here you can see the bid and the ask. If you get a contract that is right at the money, so okay, here right at the money would probably be closer to the 290, it would be worth $6.80. So for one contract, it would cost you $680. Since you are getting exposure to 100 shares, it is 100 times the bid or the ask. So you would try to get in for the 680. The broker might not sell it to you at that price. You might have to come somewhere halfway between the bid and the ask, but this would be the approximate value. So you would pay $680 for the potential right to buy Microsoft for $290. And your belief is that based on the implied move, Microsoft is going to move at least should move around $17. So it would move me almost up to $305, which is a significant move for the 100 shares exposure. But you don't get, when you own the contract, when you have the contract, you do not get a dollar for a dollar. So if the underlying moves $1, your value doesn't increase. The value of your contract doesn't increase $1 for 100 shares. What it does increase at is the rate of delta. So for every dollar that the underlying moves, your option contract will move at the rate of delta. So if Microsoft goes up by $1 and I'm in this 290 contract, I will get 50 cents, which would be, basically half of the move. So I would I would gain $50 because it would be 50 delta times 100. So that would be the increased value. So one of the things that oftentimes people conflate or confuse is that when they think, oh, the price is going to move up by $17 and I own 100 shares, so I'm going to get a $17 move. No, that's not how it works. Actually, you will get 50 cents for every dollar that the underlying moves. Now, if we go backwards, you can see that as your the price goes up and you start to be deeper in the money, then your delta starts to increase. And so for every dollar that the underlying moves, you actually start to make more money per dollar. So let's say, for instance, it's at 290 and then it goes up $5, you'd be getting around 61 cents. And then if it moved up another $5, you'd start to get 70 cents for every dollar. So every time the underlying moves up, then you start to build up more delta. And so you can make more money with the movement. And so one of the things is when people are evaluating the option contract, they're looking at all of this data to determine, where they want to be at in that contract in relationship to where the underlying is currently at. And the thing that people oftentimes that they often forget is, okay, so then you also have this Vega. And so right now, for every dollar that the underlying moves, I'm also getting this move in Vega. And that is helping me. But like I said, if let's say for some reason right now volatility is really high, this number, what I'm paying for, is 33 cents. But if all of a sudden the volatility drops or the Vega drops, and this 33 cents starts to become, starts to drop in value faster than my option contract or the underlying is moving in the dollar value, then this creates what we call a volatility vacuum or volatility crush. And that is when this value, so the theta and the Vega, are dropping faster than the delta is increasing and the underlying price is increasing. I know that all sounds like a lot, but we'll do some examples, and that should help move us swiftly along. So the other thing that we didn't talk about yet is gamma, but we can save that for later as we're looking at some of the different examples. And as I've already talked about, the risks is theta decay. So you didn't give yourself enough time on the contract and time is starting to run, but your underlying hasn't made the move that you were expecting it to make. Or you start to face volatility crush, and that's where you paid a lot for Vega, and then suddenly that Vega amount just starts to drop because volatility volatility in the market, or the price movement is too slow, and that vega starts to shrink faster than the movement of the deltas. And like I said, all of this starts to become a lot more natural as you carry on working with your options contracts. You will see all of these things over and over and over again. So we've already really talked. So again, we talked about delta. Basically, it is the amount, it's the movement, it's the increase of value or decrease value of the contract based on the dollar movement. So if your contract moves up $1 and your delta was 70, you would gain 70 cents per share. If the underlying lost $1 in value, so it dropped $1, you would lose then the 50 cents in value or 70 cents in value, whatever the delta was, you would lose that from your option contract. So that's why you need to be quite certain of the bullish move, because if price moves against you, you will start to lose from the premium that you invested. And gamma is the rate of change of delta. So it's like the accelerator in the mix. So as the price of the underlying increases or decreases, that delta changes at the rate of gamma. So you always want to look at theta plus gamma in order to see what the true value movement of your options contract will be, increase or decrease. And yeah, so I know this is a funny chart, but I still like it. My dad said it doesn't really make any sense, but that's okay. So when you own shares, you are losing this dollar for dollar, right? And so like if the price of the underlying drops $1, your share loses $1. And if the price of the underlying increases by $1, your share will increase by $1. But when you have an options contract, the way that the value increases is that as you get deeper in the money, the option contract starts to exponentially increase in value, because you're starting to get more delta as the price is moving up, and you are starting to get that delta plus gamma exposure. And if price is moving efficiently, then you're also getting a benefit from increased vega. So when the price is moving efficiently like this, it's just moving, directionally up, then your option contract will start to increase in value also exponentially. And so that's when you start to hit that kind of like horizontal peak in the value, and it's starting to move in a very similar way as the underlying price. That's when you really start to get that leveraged aspect, because now you're starting to get a more significant movement of your value, the delta plus the gamma. You're getting that per dollar, but for 100 shares. So you start to really get that exponential growth of the underlying. And please, if you guys have any questions, feel free to type in the chat or to unmute and just ask your question. Yeah, I want this to be as useful for you guys as possible. So again, with long calls, you are really looking for exponential growth, and you have a capped loss, because the maximum you can lose in a long position, in a long call, is the premium that you paid to get in. And that is true for everything that is a debit. Anytime you pay a debit to get in, that is your max loss. Whether it's a long call, long butterfly, debit spread, whatever, as we move forward, when you pay to get into something, that is the maximum you can potentially lose. So your losses are capped. But the potential growth with long calls is exponential if the price moves the way that you expect. But again, you have to keep in mind, as I have down here, that is the time decay. As time goes on, you will lose theta value from the contract. And again, the risk to reward, your max loss is if the price doesn't do anything before time runs out, then you lose the entire amount and you have this exponential, the reward is this exponential growth if you have timed the move correctly. So just to get it, we're going to do a demo on demand, but just to kind of give us a feeling, oftentimes a really great thing, a great way to determine what the general trend of the market is to look at a 1 or 2 year chart of the SPX, or here I have SPY, and I can see that the trend is moving up. I mean, it's quite obvious that back in June when I took this picture, that the price is quite consistently moving up. I have some indicators on here. These are parabolic dots, and they basically they give you from volume. They look at volume, and if the buying volume is high, the dots are underneath the individual candlesticks. And that's kind of showing you that there's more buying volume than selling volume. So as long as the dots are underneath, you know that there's still a bullish sentiment in purchasing or in volume, even if the price is fluctuating a bit. And as I shared before about the EMAs, these are 3 EMAs. So these are, since we are on a daily chart, this is the 9 EMA, the 15 EMA, and probably the 21 EMA, but I can't see it up here. It's probably off the side. But because they're stacked from the smallest to the biggest number, essentially that is the amount of data that it is averaging. Because they are stacked most often in this chart above each other, from the 9, 15, and 21, that also is a bullish signal, because it means that the candles are consistently printing with positive or with bullish values. All right, so you want, when you're determining if you want to get, oh, this is actually a weekly chart, my apologies. So if you want to get a sentiment of what the market is doing, the SPX, SPY, NDX, QQQ, those are all good. You know, throw up a weekly chart, just see like how you're doing or how we're doing generally. So you have a feel for the market as, you know, the general market, not just whatever it is that you're underlying that you are considering. So you do want to find this trend. You can use a weekly or a monthly chart. Then once you've found the overall trend, you do want to find the short-term trend, because of course you need to find an entry point to your long position. Then you want to find the short-term trend so that you can catch that positive move and that positive momentum. So the other thing, like I previously explained, is that some people like to use indicators like the moving averages, because normally what will happen is, well, depending on the underlying you're using, you can see where the underlying likes to return to a moving average before it has a substantial kind of what they call like a bounce off. But every underlying is different. So you really have to do your research. Some like to move off of exponential moving, the 50 exponential moving average. Others like to really run closely to maybe like a 20 EMA. So you need to just look historically over the last few years, what were strong points where when the price came back to that moving average, then it had a systematic bounce up. And then you can wait for price to come back to that moving average to, you know, enter your long position. And some people like to use exponential moving averages. I prefer exponential moving averages. and some people prefer simple moving averages. The simple moving average basically just looks at whatever the number you selected. It looks at that many candles back from the current candle. So if you're looking at the simple moving average, it will look at 9 candles back, or 15 candles back, or 21 candles back, and then it will average them equally. I prefer the exponential moving average because it's weights slightly heavier the candles that are closest to the current candle. So the reason I prefer that is because it is taking into consideration the current movement of volume. So I do want whatever has been happening to count slightly more than what happened further back in the chart, whether it's a daily chart or an hourly chart or a 15-minute chart. So the other thing, you want to watch volume. If you are getting into a long position, you do want to have volume and momentum on your side. And so if you are looking at your position and you see that there's really low volume, or historically low volume for the market, then it is going to be difficult to get that really strong bullish move to your side. So the other thing you can look at is the implied volatility percentage and rank, and compare those together. So the IV rank is basically looking at the year high and low, and then seeing where we're at currently, where IV percentile is looking over a certain number of days and then giving us kind of the average and then telling us if that is high or low. Neither of them are really perfect, but it does help give you an indication of, if the annual rank of IV of volatility is higher than the average amount of volatility in the market in relationship to that particular underlying. So if both of them are really high, then that the prices of the option are going to be inflated. So again, on your trade tab on the option chain, you will find the underlying that you're looking at, the current price, and oftentimes you will see the MMM, which is the market maker move, which is the amount of the dollar movement that the market maker believes the underlying is going to move. And they will post that if it is different than whatever the implied volatility was and implied move was on the option chain itself. So you will come out and you'll look at the different expiration dates, and you will also check to see what is the implied move. And this is where you are going to determine if you are being honest with yourself about how much you believe the underlying is going to move within the amount of time that you have paid for. And when you go to your option tab, you will want to buy to open a single option, which is then if you do it on the call side, when the order form comes up, it'll show you buy single, and then it'll have the call. And again, you will want to look at your deltas to see what is the correlation between the dollar move of the underlying and your exposure in the deltas. So as Leona was asking, how can you do that, those technicals? So you can take so you look at the current price, and you look at the implied move, you look at the delta, and you look at the theta. So theta whenever you're in a long position, theta is always negative. So you will take the implied move and you will multiply it by delta. And then you will take theta, which is the dollar amount you are losing per day while you are in that option, and you will multiply it by the days till expiration that you have. And then you will subtract those two numbers from each other, and that will give you your potential profitability. So I know that might sound like a funny equation, but basically, if the market maker tells me SPY is going to move $11 and I want to get a 60 delta, so I will multiply this $11 by 60 cents, and that'll actually tell me how much my contract will increase in value. But because of the fact that I'm losing theta every single day, I need to know how much I am potentially losing from that time value. So then I need to look at my negative theta and the number of days till expiration, so that I am also determining how much quote unquote slippage I am getting because of the loss of theta. And that will help you figure out what your potential profit is and what your target should be. So if this is telling you that your profitability ends up being it, when you do all the math, if it comes out to be that the profitability is going to be $5 on your option contract, then you probably don't want to wait until the final expiration to see if you got the whole $5. You probably want to just say, okay, I have this many days until expiration. Halfway through would be approximately how much profitability, and then use that as your profit trigger, or just have a set amount, like you're looking for a $1 move in the underlying or something similar. So a lot of times, again, people will want to minimize how much it costs to get in. So they will look at contracts that are slightly out the money. And when you do that, the delta is a bit smaller. So when you are in the money, when you are deeper in the money, so the strike price you select is actually lower than the current price, you will pay more for your contract, but you will have a higher exposure to delta. So you won't need the underlying to move as many dollars in order to get that profit trigger. Excuse me. But some people will like to be right at the money, because that's where gamma is the highest. And you do still have a very decent, delta exposure. And usually at the money is around somewhere between 45 and 50 delta. So you can just generally say to yourself, okay, if I want to make $1 in the increased value of my option contract, so if I want to make $100 per contract, I actually need the underlying to move approximately $2. So, I mean, it just kind of gives you 50, that 0.5%. But then some people are like, well, I can't really afford to pay $460 for just one contract and only make $1 on the move. So instead, I want to go further out the money, where one contract is only $160. So the current value of SPY is $440 here, and you're actually getting your strike price at $445. But your delta, because you're further out the money, your delta is only 27 cents. So in order to make a $1 increase in value on your option contract, you need the price to move $3 approximately. And so you need the price of the underlying to move $3 instead of just $1. So this is the math that you need to do, because what some people will say is, yes, but if I'm a little bit out the money and the contract is cheaper, I can actually get more contracts. And so actually I still only need to have a $1 move of the underlying, because I am actually able to purchase so many more contracts, because the contract at the money is worth $4.60, where the contract that is out the money is worth $1.61. And so I can basically get 3 contracts for the value of this one contract that is at the money. And that would, quote unquote, with 3 contracts, my delta in the combination would be almost 80 cents. So they would say, well, it's better for me to have 3 contracts that are out the money than to have 1 contract that is at the money. Now, that is all math you have to do based on your contract size. That's just the reality. No one can say you have to do it like this, or you have to do it like that, or whatever. You just have to make sure that what you are doing is making sense based on your account size. So some people don't want to be in their positions for a very long time. So they would prefer to be a little bit in the money, because they want to catch that morning momentum move in the market. They just want to get that $1 scalp. And because if they're in the money, they're going to get this 70 delta exposure. So they're getting closer to that 1-to-1 movement for the exposure to 100 shares. So that might be the reasoning they have in their mind, where another person is like, well, I don't mind being in the trade for maybe even 1 or 2 or 3 days, because this is a bullish season for for oil. So I don't mind being in this energy stock for the duration of the winter months, because energy stocks tend to do really well during this period. So you might have your own reasoning. It's just whatever you decide to do, make sure you're doing it with a strong thesis, because oftentimes what will happen is people will do something. They'll be like, oh, I don't have enough money. Okay, I'm just going to do A, B, and C, and D. They do that thing. But then when price doesn't respond exactly the way that they want right from the beginning, they start to get really nervous. And the problem is that they just don't have a strong enough thesis into why they entered a particular type of contract and what the underlying is actually going to do. So this is also, again, the same thing with the variations and the cost. So as something that you will start to hear all the time is this thing about moneyness, being in the money and out the money and at the money. So with your long call, when you are out of the money, that's when you start from where your strike price is, whatever you entered, whatever you chose to enter as the strike price of your contract. The further you go out the money, so basically price is dropping below you, you are starting to realize losses, and that is out the money. And as you go deeper in the money, the deltas start to increase in your favor, which increases your profitability. So that is the moneyness. This is in the money, at the money, and out the money. Here's Google, and Google is a big mover. So this is back in April. And so one of the things that I like to do is I like to look at kind of the historical chart. I like to look over a year to see how the underlying likes to move, how it responds to things like being overbought or oversold, what the buy volume is. Now, this is actually, I am going to remove we have too many things on here. Oops. So I'm actually going to remove this. Yeah. So I will send, if you guys are interested, I can send you this script, but this is actually volume, but it's actually volume, the sell volume and the buy volume. And so I I just think this is extremely helpful, because when you're in a trade and you are expecting bullishness, you want the volume to be buy volume. So you need the buy volume to be stronger than the sell volume, because then that means that people are still buying, and other people are just taking profits because maybe it hit their profit trigger, or a hedge fund has now reached whatever their expected move is. And so the hedge funds are constantly taking profits along the way. But as long as the buying volume is better than the selling volume, and significantly better, you can have a sense of confidence that price is going to continue to be bullish. Yes, I will definitely send it around. So I like to look to see how a stock likes, just like that, how it likes to move. And one of the things that I've with time, just that I've trading Google and watching Google, is that Google really likes to move, likes to do a consolidation. So, it will have this kind of this bullish move, these bullish moves, and where you will see the price kind of go up in a corridor, but then you will see that it has, even inside that channel, it will have kind of this fast move up, and then it will go sideways. Then it'll go have this like big move up, and then it will go sideways. So it kind of, so if you are getting into a long call, you wouldn't want to get into the call during this consolidation period. You would want to get it when price has come down to the bottom of the channel, or has already gone sideways quite a bit, because as we can see, when it hits the top of this channel, then it starts to reject. Now, one of the other things is that you might notice is that so the purple EMA, this grayish color, is the 9. So that's the faster moving average. And the blue is the 20. So it's a slower moving average. But Google is not consistent at keeping the fast moving average above the slower moving average. So, or the bigger moving average, but it is actually called slower and faster. So when you are bullish, you want the faster moving average to be on top. And here you can see that is happening right now. But during this consolidation period, they're almost flat with each other. So right now I see that the two EMAs have kind of like separated. So I feel like, okay, there has been a really big bullish move. And now even here on the volume, you can start to see that actually volume is starting to flatten out. So I would not necessarily want to get into a long call here. I would be nervous that this thing is going to potentially just go straight, like flat for a little bit. So that would be my thesis. You might have a different reason, just because you love Google, and you just think that it is going to do amazing things every day, day over day. And so you decide to get into a long call. So we will get into a long call, even though I think that that's not quite the best decision, but just to see how I don't know why there's so many strikes out here, just to see how it moves. So we will buy one at the money, and we just need to get one. And that is going to be so expensive, but $36,000. So thank God my fake account has $100,000 in it. And then we will get one that is further out the money. So around the 30 delta. But because we want to see how this out the money dynamic works, we will actually, for the same amount of money, we can get, I think it's 3 of these. So confirm. Yep, that's close enough. So, and that again is why, like I was saying before, that oftentimes people prefer to be a little bit out the money because they can actually buy more contracts. So you need to have your own thesis. Now, I've actually, wow, I bought a leap. So that's why it was so expensive. So we have time. We can see what Google decides to do over the coming weeks and see how our how our trade is developing. And you can see here when we had that huge jump up, the green volume spike is quite astronomically high. Then it kind of reverts to the means and we're going flat. This is taking a long time to catch up, but it looks like price is now just riding along at the top of this trend line, which it did here as well before it started to drop. But this thing just wants to take forever. So on our monitor tab, we can see that our single call has increased in value by $2,300 approximately, but our out the money call has actually increased in value by $3,500. So by having that out the money position, we were able to access more contracts, and prices obviously moved slightly in our direction from when we got in. And of course, Google is really a big mover. But then let's just say that we carry on in this position. Let's see. Oh, we're continuing to be bullish. Wow, we would have made good money here. So we're riding that trend line, even though, I mean, we still have the, what do you call it? Buyer volume is still outperforming seller volume. So even though the volume isn't excessively high, there is more buying than selling. Again, you can see that our out the money call is actually performing better because we have 3 of them. Now on the trade tab, what we can also see is how far we're getting in the money. So the one contract that we had that we bought that was at the money was at this 50 delta originally, or 54 delta. Now it's come down to the 63 delta, and our out the money call is now less out the money, but it's still around the same amount of delta. So the deltas haven't changed that much, even though both of them are actually going in our, well, one is going deeper in the money and the other one is coming at the money. So now we can go forward a couple of weeks. So we can see that the selling volume is starting to outperform the buying volume. So this would probably have told us that now is a good time to get out. And now you can see that we have actually lost value on our contracts. So the price has gone against us, and now we've lost about $1,000 on each of those contracts. So because the price has just flattened out and actually has now, even though the price is actually above the last place that we looked, but we're starting to lose that positive volatility of the stock going in our direction. So we've seen this drop, and so we could decide, do we stay in, do we leave, do we do whatever? So let's just carry on and see what happens. So we've had this kind of correction. As I was sharing before about the moving averages, you can see here that when we dropped back into the trend channel, that the faster moving average has now moved below the slower moving average, which is a bearish symbol. So we actually should have exited here, because this is telling us that price is now going to start moving against us. Now we decided to be patient and because we're obviously trying to see what is happening over a longer period of time, just to see what happens with the call. But and price now has come back up. So now the faster moving average is now above the slower moving average, which is good. That's now a bullish signal. But we have more buy volume than sell volume, so we can carry on. Oh, let's see on the monitor tab, how much money. Wow. So our long call that was out the money is now worth $8,000, and our long call that was at the money is now worth $6,800. Now, remember when we got in, these were approximately the same price. So now let's keep going. So let's just come all the way forward and let's see. But Google has continued to be bullish. It has not done as I expected. It did not have a really strong consolidation. It has just continued to trend upwards. And our calls are now worth together almost $40,000. But of course, it did cost us $40,000 to get in, almost $40,000 to get into each of them. So now we've basically we have doubled our investment. So we now have 100%. No, we have 50% return because each of these cost us $36,000. But how is that possible? Because here it's showing us 137,000, but it cost us 36,000 to get into them. Okay, I don't know. So that does not make sense. It's like it didn't take off the money that it cost us to get into the trade. So we can carry on going forward. But this is, I mean, since this is so bullish, maybe we should find something that is flat. Now, let's see, something like an AMD. So that trades in a channel. So let's say, for instance, we decide, well, so as I was saying before, we mark out these support and resistance lines. I put these in myself. You hand draw them. They're not given to you. So every time that AMD came down to this support line, it then bounced up, but then it did create a number of different resistance levels. So you would want to watch it to see if it actually passes through the resistance or if it's going to get bounce off and have this rejection, so that you're not staying in the call like as it's basically retracing back on itself and it's losing its value. We can buy something here and do something with less time so that we can actually feel the theta pressure. So we'll buy again one at the money, and then we'll buy in the equivalent amount of money something out the money. And then we'll go to okay, this is close. So we can only get 2 of these. That's actually more than, yeah, that's more honest distribution. Oh no, in July, AMD actually was bullish. So that also won't necessarily give us an example. I wanted us to see when theta is more negative than the dollar movement, so that we could kind of see what that feels like. So let's see on the chart. So now price does drop below our value. And so here you would have to ask yourself, what percentage is like, what percentage of a loss on my investment would cause me to get out, and then you could close it out, or you could put in your stop loss if that's what you would want to do. So that would be up to you. So now you can see that how theta is every day. So it gives us sorry, just one second. So on your trade tab, on your monitor tab, I'm sorry, it will show you how much you lose in value every day from theta. And it will show you what your changing deltas are. And it will show you what your delta is all together. And it will show you also what your Vegas are for your different positions. Now, the good thing is that if we had screenshot this when we first entered, we could see our deltas becoming more positive, which would be good. Is it outperforming our negative theta, which it is? But I mean, look how close that is. This is positive 186, and this is negative 117. So the difference is, it's important, because somebody might just think, wow, I have all this delta, but they don't realize that the amount of negative theta they have is quite significant. So all these are all the pieces that you would have that you'd want to pay attention to. And here is our profit loss. So the question that we would have is, we could go back to the chart and try to decide, do we believe that AMD is going to bounce up? Do we is it a seasonality thing? Do we think that it's going to bounce back up and move through these resistance? Or do we actually think that price is going to move back down to this support area, that it'll move back down to the 72? So after we've done maybe some analysis, we see that there's strong, there's more selling than buying volume. The EMAs have flipped on top of each other, and we are at approximately, and now we are starting to face a loss, and we only have 25 days left, and we are losing theta, but it's not at the worst rate, but still, this is not what, we obviously are not getting into this for a loss. So we could close this position if this hit our stop loss trigger. I personally, I prefer to look before I close out a position. If I can't watch and I'm worried, I would put in a stop loss, but I do like to see what's going on, because oftentimes there could be an indicator that's showing me that there's maybe a influx in the price, that there's a bit of a drop, but maybe we're going to come back up. I like to see all of the information before I exit a position, because the worst feeling is when price comes down, taps you out, and then goes in the direction that you were expecting. But if you can't watch it, then definitely have a stop loss in. Don't have that worry in your mind. Don't have that worry in your mind when you're away from your computer, like, oh, what's going to happen? But you have to determine what your percentage is for your stop loss, and then you can create your closing order, or when you enter your trade, you can put in a stop loss. So we went through a lot on the Greeks, and I hope that we talked enough about developing the thesis for why we would do a long call. But please, if you have any questions, feel free to unmute and ask, or if there's anything that I have maybe overlooked in our demonstration that you would like to talk about, let me know.
Could you just go back to the slide? It was towards the beginning. At the top, it talked about options, Greeks, delta, but at the bottom, it said gamma. I had missed it, girl. I'm sorry.
No, not at all. I actually didn't, because we talked so much about the Greeks, I didn't spend a lot of time talking about gamma. But essentially, gamma is, oh, here it is, my bad. So gamma is the rate at which delta changes. So if you had noticed before that as you're going deeper in the money, the delta is increasing, and that is determined by gamma. So as your the underlying increases in value by $1, then you get not only delta, but delta plus gamma. So then when there's the next dollar move, then you have then that combination of the new delta plus the gamma of that new strike. And it's always on the, well, it's not always on the option chain. You have to add it to the layout, but you get this delta plus gamma. But gamma is highest at the money. So if your position starts to go really deep in the money, you will start to notice that you're no longer getting that gamma exposure, because you're getting closer to 1 and with the delta, which means that your options contract is almost moving at the exact rate as the underlying. So there's no more no necessity for acceleration of the delta, because it is moving in such close, moving in tandem with the underlying. So that's one reason why a lot of traders who focus on gamma scalping will constantly be just like taking, as they are losing that gamma exposure, then they will roll their position up to be closer at the money, so that they're getting the delta plus the gamma and acceleration. So yeah.
Can we go back over the volatility crush, please?
Yeah. So let's see. I'll go back to think or swim, and then that will, so as you notice, whoops, on the monitor tab, we have here Vega, and depending on, let's say, for instance, when we bought this, let's go back to when we bought it. Let's see what the Vega was. The Vega was 25. And so I've paid for 25 I've paid for, in my option contract, this Vega piece. And as the price is dropping on AMD, so was the Vega. And so this value, as it starts to drop, and the theta is already negative, so every day I'm losing that value, those two in combination are kind of like this constant vacuum sucking out a little bit of the value of your option contract. So you need the other pieces to be creating more value and minimizing this kind of drop from this slight loss from theta and Vega. Now, the other thing is that when time starts to what they call squeeze, as you're getting closer to the end of your contract, theta will increase in value. So here you will start to lose more theta towards the end of your contract, which is why I was saying before, if you've been halfway through the contract and price isn't doing what you expected it to do, then you should close the contract, because theta will start to be so negative, and it will and the other Vega and the other volatilities, which you don't see on the option chain, will also start to drag down the option price. So here you see that the theta is -18 and Vega is 21, but now let's go closer to our expiration date. Let's see, that is the 13th of August. So we'll go to the 9th. Now you see that Vega is 9 and theta is -103. So you see, like, we actually had a 24 value Vega. So we paid for that 24, and now Vega is 9. So we've like lost that piece of the value in our contract. And the delta hasn't really, whoa, the position of AMD must have significantly changed. Oh, this is the day that it shot through the roof. Okay, so we now have a very valuable call. But even still, the good thing is that our delta is so high, like, because price shot up. So, you know, and we're in the money with both of our calls. Now the delta is really high, and so it's outperforming this negative value on theta and the drop, because now we only have Vega at 2.9 and it was at 24. So we lost 22 points just on Vega, but because delta was moving so exponentially fast, it didn't crush us. But if we hadn't had this huge outsized bullish move just towards the end of our options contract, we would have lost a lot of value on the Vega. Does that make sense?
Yes, it does. Thank you.
Mm-hmm. So sometimes what will end up happening is that people will see, like here, for instance, like, oh, AMD is starting to run, so now I want to jump in. And because AMD is already running, the momentum is already really high, the volume is already really high, they will pay a really high price for the implied volatility. That's not Vega. Vega is another volatility, but it's the same principle, essentially, that when that volatility starts to drop, like here, where AMD then starts to have that curve, if we would have bought our call like right here, we would have, if we would have bought it here, no, that's not what I'm looking for, my apologies. If we would have bought it here and then price started to move against us, then we would have paid for all the volatility, and we would be losing volatility, and price would be moving against us. And that's when you have what they call volatility crush. And it's just that the volatility, what you paid for in the volatilities was just so much that it's losing value faster than the underlying can catch up. Anybody, any other questions? I know that most of you guys probably already know all about long calls and are confident with them, but it's always good to have a refresher. But if you do have questions, if anything was unclear because this is maybe the first time you're hearing about how to enter long calls, please ask all the questions.
So may I ask a question?
Yes.
So you're saying that the reason why people are seeing that the underlying's moving, but their options not, it's because of either several things. Their theta is working against him, volatility crush, and is it anything else?
So, I mean, here we see that the deltas are like super high because we had this great, like, pop. But if we had, let's say, for instance, it had remained flat, what we would see is, well, the Vega would have dropped significantly, but there would just be no movement in the underlying, because the underlying has to move the dollar to get that delta move. So if the dollar is not moving, then you're not getting that dollar plus gamma action. So, and if you've lost, because here we're just looking at the theta that we're losing today, but don't forget that we have already been in this for we were already in this for a couple of weeks, and we were already losing all of that theta every single day.
Got it.
So that's why in that formula, it's really important that, when considering where, no, I think it's further down, is not this part is not forgetting that you want to subtract theta times the days till expiration, so that you know how much you're losing potentially altogether from theta, so that you can see what the move has to be in order to overtake this loss in theta. And this doesn't include if you have a decrease in volatility, because you entered your long call when volatility was increasing when volatility was decreasing instead of when volatility was increasing. Like maybe you bought just before earnings or something.
Also, question for you, like delta, theta increases as time increases, right?
Yes.
Time to expiration, sorry.
Yep.
Yeah, thank you. Well, decreases as time to expiration decreases.
No, theta is the negativity increases.
It says as you get less days, as you get
so
closer to your expiration.
Yeah, the curve is like this. So the drop, or the drop of the value of theta becomes exponentially faster as you get closer to expiration. So it's that, so in the beginning, theta will be decreasing, but it doesn't feel like, you won't feel it very much. But but as you move towards expiration, it'll start to increase. The negativity will increase faster until you're like almost at expiration, and then it just falls off till there's no value left in your contract. There's no more time value in the contract.
Suzanne, may I ask a question?
Yes.
On that last slide, you described those as parabolic dots, or propulsion? What are they?
Yeah, it is propulsion dots, but in the
okay.
when you look at them, it doesn't say propulsion. It actually says parabolic.
Okay,
You want to find it, but they are a propulsion indicator. They're a momentum indicator based on volume.
Okay, my question to you is, going back to theta, delta, and all those. I know IWT teaches us when we buy long calls to buy 60 days, but not everybody has that 60-day money. So how can we use the Greeks to know if we've gotten enough time? How can we do this more technical?
Yeah. So
instead of just guessing, I'll just buy a week out and give myself time, or 2 weeks out and give myself time. How can I be more technical about it?
So using the implied move, that will give you what the broker believes the dollar movement of the underlying will be. And then I will show you a formula you can use that will actually help you kind of have a more reasonable view of how much time you need in order to catch a smaller move, because you will have to catch a smaller move if you want to buy less time than the 60 days. But I will show you that down towards the bottom, how you can estimate the probability of profit or potential profitability. So you look at the current price and you look at the implied move, you look at the delta, and you look at the theta. So theta will whenever you're in a long position, theta is always negative. So you will take the implied move and you will multiply it by delta. And then you will take theta, which is the dollar amount you are losing per day while you are in that option, and you will multiply it by the days till expiration that you have. And then you will subtract those two numbers from each other, and that will give you your potential profitability. So I know that might sound like a funny equation, but basically if the market maker tells me SPY is going to move $11 and I want to get a 60 delta, so I will multiply this $11 by 60 cents, and that'll actually tell me how much my contract will increase in value. But because of the fact that I'm losing theta every single day, I need to know how much I am potentially losing from that time value. So then I need to look at my negative theta and the number of days till expiration, so that I am also determining how much quote unquote slippage I am getting because of the loss of theta. And that will help you figure out what your potential profit is and what your target should be. So if this is telling you that your profitability ends up being it, when you do all the math, if it comes out to be that the profitability is going to be $5 on your option contract, then you probably don't want to wait until the final expiration to see if you got the whole $5. You probably want to just say, okay, I have this many days until expiration. Halfway through would be approximately how much profitability, and then use that as your profit trigger, or just have a set amount, like you're looking for a $1 move in the underlying or something similar. Yes,
Suzanne, I have a question.
Mhm.
Right here in this, when you're doing the single buy, are you going to put like a stop loss or some type of trigger just in case?
So right now I'm just trying to see, let us see what happens, with the movement of the Greeks. So I'm not putting in a stop loss here, but you could either put in a stop loss, or you could put in an alert to trigger that if price dropped below a certain amount of money, that then you would exit. So that would be your choice.
I have a
Yes.
question.
Mm-hmm.
Okay, I've never done options yet. I'm just learning, and I'm also just learning Thinkorswim.
Oh, good. I'm actually
And-
really, really glad that you are here. Thank you for joining us. And please ask all the questions.
So I'm not really clear on when it's a good idea to buy in the money or out of the money.
That is a more of a personal choice.
Oh,
So different teachers will teach differently, and part of it depends on how long you are supposed to be in the trade. So there are some teachers who really are only expecting you to be in the trade for maybe a couple of hours. So they're expecting you just to be in for either that power hour at the end of the day, or that momentum move, like right at the moment in the morning. And so oftentimes they'll say it's better to have more contracts out the money than to be at the money. But if you are, let's say, doing a leap, or you're doing not necessarily like 1 year, but let's say, for instance, you are looking for a stock that's like having a seasonal move. So like oil, you're just expecting that XLE is going to do really, the energy ETF is going to do really well, because now we're in winter, and usually that's when, you know, oil and gas tend to be more expensive. So those, that sector tends to do better in the winter months. So you're expecting to be in it for, you know, a while, then you probably would want to be closer at the money, because one of the things you might end up wanting to do later, which we'll talk about in the next later classes, is you might actually want to also be selling against the position in order to bring in a bit of income, so that you can minimize the overall cost of the long position, but then you automatically have a higher delta. And for those who like to sell against their positions, they might also want to be in the money, but that is much more expensive. And that gives you the feeling more of buy and hold than having this highly leveraged kind of piece of equipment. This like a higher leveraged contract. So it's really, it depends on your entire account, what your risk appetite is, because when you are further out the money, it is riskier, because you really you're not paying as much for anything. So in that sense, it's riskier that if you don't catch a really big move, your out the money contract could just do nothing. But if you are in the money, you also have this exposure to the high delta, because you just need the price of the underlying to move against you $1, and you could be losing, you could be losing a 70 cents. So you could be losing a significantly more money on even smaller moves that are moving against you. So it's really up to the person and what their risk appetite is, what they are, what they're hoping to achieve, and also what their overall sentiment is in the market. So for instance, if you are really high delta, and like right now we had that, all that whole week of bearishness, all of your, even if you had been deeply in the money, you would, by now you might be totally out the money, and you would have just lost all of that movement. So you just need to know, you just need to have in your mind what your risk appetite is, but also then having those stop losses. But if your stop loss is really tight, you can easily just get, when you have a really high delta, a $1 move can significantly change the value of your contract and end up tapping you out very quickly, because the swing in your move is more valuable. So when you're out the money, you might lose $2 or $3, but you might only lose some cents on your entire, on the number of contracts you have, because you didn't have that much delta exposure anyways. So it's all about your risk appetite, and how you want to hedge. If you want to have, a tight stop loss, or you want to sell against your position, these are all things that you will start to, or how much conviction you have. Do you really believe there's going to be like a $15 move, and you don't mind being a little bit out the money because you prefer to have more contracts? That's all has to be going through your That has to all be in your thought process.
Okay. Thank you. I'm trying to learn, so I'm listening and making notes. Thank you.
So one of the big things that people don't talk about, and I do talk about this in trade management, but we can also talk about it here, is that it's when you are dealing with a moderate sized account, you don't want any one position to be more than 2 or 3% of your account. But when you are dealing with a smaller account, then you might not have a choice. It might just be that one position is going to be a larger size of your account. And because of that, you can't cope with you can't take as big of a potential loss. Like your stop loss can't be so too far away from you, because you won't be able, like if you have capitalize that loss, it might end up being like a 2-3% hit on your account. And if you do that 2 or 3 or 4 times, then the drawdown is just too much. So the important thing is actually both knowing what your like profit trigger is and what your stop loss is, but also making sure that you are not getting so deep into one position that you are like starting to jeopardize 10 or 15 or 20% of your account in one position. And so that's why sometimes those with smaller accounts need to be a little bit out the money, because it's just not possible for them to be at the money without risking an outsized percentage of their portfolio.
Do you have any Thinkorswim training videos anyway? Do you?
So I just use the Thinkorswim platform on the videos. I haven't done any like specific videos on training with the platform, and in part because the TDA webcast series on YouTube is quite robust in the training with their platform. But if you have any specific questions, feel free to ask, and I'll be happy to help you, or to do to link up a video. But I mean, everything that I know from the platform, I learned actually from their YouTube channel. And and you get every 6 months, you get a 30-minute, I think they changed it to 30 minutes or 45 minutes, one-on-one training. And so you can schedule every 6 months this 30-minute one-on-one training, and then they will answer all of your, like with a specialist, they answer all of your questions.
Okay, great. Thank you.
Right. Yeah. Thanks for that information.
Yeah. They're wonderful. They will, and you can give them permission to like remote, to remote access your mouse. And so they can actually show you like, oh, if you go here and do this and go there and do this, and they can show you, easier ways to do everything. And yeah, they're extremely helpful.
Good.
I have a question.
Yes.
So is it possible for you to show us like how to put in how to use this formula to put in like a take profit order and possibly a stop loss? Because that's where, so with options, like if I'm doing like regular shares, I know I want to get out at $70, but with contracts, it's hard to figure out like what the stop loss should be.
Yeah.
And the take profit.
Yep. So yeah, if you right click buy custom, you can do this OCO bracket. And so the top one is to buy, and you put in whatever your limit order is. And then what you can do, the first one is your profit trigger, the first option they give you. And so let's say, for instance, you want to capture a dollar move. So you would say that when the value shifts to $6.20, then close me out. Or you can then put in a stop loss, and you can say like, okay, I don't want to lose more than 5%. of the value of whatever this 5%. So 10% would be 51 cents. So then I would say, okay, I don't want to lose more than 25 cents on this value. So if it drops more than $4.95, so yeah, then close me out. So
And
this-
with that $25 per contract, or is that how that would pan out, or would that be something? So if it was $5.15 and you do minus 25 cents, would that be? And
So
you
if
get
you
10
had one-
contracts, $250 loss. Okay.
Yep. Wait. Yeah. That would be, no, it would be $25 loss.
No, I was looking because you had 10 contracts.
Yeah, sorry. Yes. So if you had one, yeah, exactly. So this is essentially what you would do. And then when we confirm it, so it has filled us, and on the chart, you can see that I have these two triggers. So we can actually see what they're like on top of each other. If I actually zoom in, you will see them, both of them. Can you see them?
Yes.
So then depending on what price does, now will determine if it will, leave me in or get me out. I can go forward. Let's see.
Is there a way to like drag that to a specific price level, or can you just have to do that by
with
dollar amount?
options? Yeah, with options you can't, but you can do cancel replace. So if you want to, you can cancel the whole thing if you want, or you can cancel replace the order. And then it's, since I clicked on the stop loss, I could change it, but it should have actually gotten me out now. So I don't know. Yeah, it did while the thing was still, what's the word? Yeah, while it was buffering, it was, we ended up getting tapped out. So it hit our stop loss. But did I go too fast? Is that, do you want me to do that again? Because that closed up really quickly. So we'll try not such a, by custom. So either with so I just use it, I just put it in as the stop. I don't do like a stop limit and this and that. I don't have any, it only becomes a problem. Like I only change this when I have multi-leg strategies, then it's better to have a stop limit. But if it's just a single leg strategy, you can just put a normal stop and then have your stop loss. Unless you want to do a trailing stop, then where are you, trailing stop? Normally it's just, no, I don't want, never do market. There.
Yeah, I don't think you can see trailing stop when you are doing on demand.
Yeah. So here, I had to unlock it. That's yeah, okay. It's not letting me see it. Oh, there's the percentage trigger. So you can have it trailing you by a dollar amount or by a percentage or by a certain number of ticks. But I don't think anybody's using that, using ticks here, but yeah. So usually I just have it in the dollar amount. So I'll say that if it drops below a certain percentage, but more often than not, I'm watching it. So if I'm in like a really short like a really short play where I would be looking for this smaller profit trigger, usually I'm able to watch the market, or I'm in a longer position, and so I don't want to have the stop loss too close, because I'm expecting price to fluctuate while it's making the move that I'm expecting. Then maybe after a couple of days, if I see that price is made in like a long call, I've seen that price has made a bullish move, then I would then I could set a stop loss, but I would do it after it's made a bit of a move. That way, while it's kind of breathing, I don't just get tapped out for a loss, because that's just happened to me so many times where I end up getting closed out prematurely before the move has actually been made. But that's of course because only when I'm able to watch it. But if I'm not able to watch it, then that's different. There were some hands raised. I'm sorry if I missed you guys.
Hi.
Hi.
I was just wondering, I know you said it's going to go onto another site, but until then, will it be pinned in the group so I can like rewatch it real quick, or no?
So so it should be up really quick. It should be up quickly. I don't think that will be the problem. So I wouldn't worry about that. You will have access.
Thank you so much.
Mm-hmm.
Do you do this weekly or daily or certain times a week?
Yeah, so usually, so we were doing them on Sundays, but now because we are starting really from the beginning, we're doing them Tuesday and Thursday at 3 EST. So we'll do them twice a week, because then we can cover more material that way.
Okay, great. Thank you.
Mm-hmm. No problem.
Suzanne, for smaller accounts,
Mm-hmm.
you've been using, these well-known, highly liquid, kind of high priced, even sometimes at the contract price level. Are there highly liquid, smaller stocks that would be more attuned to a smaller account, a starter account, where you could do your tier one types of single leg options while we're gaining experience? Thanks.
Yeah, so that's where I would go more towards the ETFs, especially the spider ETFs. They're not doing particularly well just like right this second, but normally because they move with seasonality and they move cyclically, and they move with like different seasons. Some are like considered risk on or risk off. They are less expensive to get into. So you can see over here on the side, you have like your XLE or the XLF for financials, or XLI for industrials, K for tech, so on and so forth. So you can look at certain sectors that are in high seasonality and then potentially get into those. But ETFs tend to have a lower cost basis. And yeah, so they're easier to get into, but they don't have as big of moves. So you do need to be a bit more patient with them. You do have to give them a bit more time to make their move.
Thank you.
Yeah. And you can,
Susan,
Mhm. Yes.
this is Charlene. I have a quick question
Yes.
for you.
Mhm.
Thank you so much for having the session, by the way.
Mhm.
How do I get the lock off? This is the option chain. How do I get that lock off?
So on the option chain, when you're buying the call, you mean?
Right, when I go to set up the option
Here?
chain, I notice there's a lock on it. And how do I get that off?
You just, okay, so basically what it's telling you is, so if you want to set the buy price, that's not this mid to natural. So when the lock is open, it's going to automatically select whatever the natural buy price is at that moment. But let's say, for instance, you're trying to be really aggressive and you're waiting for a bit of a pullback and you want to drop the buy price down, then you will have to lock it so that it doesn't fluctuate with the bid ask spread of the underlying. But if you don't care, you're just trying to get in as quickly as possible, then you just left click and it should toggle off.
Left click and it toggles off. Okay, I'll try that. Thank you.
Mhm.
Are there any suggested, I'm sorry, I didn't have my hand raised.
No, it's okay. Mhm.
Are there any suggested stocks to trade for someone who's just trying to learn?
So, I mean, I do like the ETFs, maybe not right today because the market is being a bit, has been a bit bearish, like right at this particular moment. But I like the spiders, so like the XLs, because they do move in a predictable way. So if you are looking for just, a small move to practice, then those are lower cost basis. So you won't take as big of a hit if you are wrong. And yeah. And so they're a bit less expensive to get in, but they do take more time because, like, for instance, an XLE, the implied move is usually just around like $1.50 a week, or even less than that, maybe like $1 a week. But the other thing is SPY is also, even though it is a bit more, it's a bit more expensive, it's not the cheapest. But the good thing is that because it consistently moves about $2 a day, you can focus on getting a 30-cent or a 40-cent move in SPY, and then trying to build up your thesis on which indicators work the best for your entry and for staying in the trade longer or shorter. So if you're looking just to do long calls, and generally, I mean, okay, right now the market has been a bit bearish, has had a bit of a correction, but generally speaking, the market does tend to be bullish. So based on that, I mean, being in something like SPY is easier to manage, I think, than because it doesn't just have these huge whiplashes like you would get in more volatile stocks.
Okay, thank you.
Mm-hmm.
One quick question.
Mhm.
What is that? Those parabolic dots?
Yeah.
Is that a study on TOS?
Yep.
It's called parabolic dots.
So I will, I always go to the wrong. Yeah. So on the studies, it's here. I always just put in para. So it has the parabolic SAR and then the crossover. So one of them is the dots, and then one of them is the crossover is actually an arrow. So it'll show you when the calculation is flipping from bullish to bearish or bearish to bullish, that it'll give you an arrow like that now it's shifting the trend. I can put it on for you, and let's see if, yeah, so here you can see that it's giving me those green arrows. Do you see it here and here? They're kind of tiny. but that's when, yeah, it's this like crossover. And then you can see that the EMAs are slightly lagging. Right after I'm getting this, this arrow, I have the death cross,
Right.
or the
Okay.
fast moving average is dropping
Crossing.
below. Mhm.
Got it. Thank you.
Mhm. All right. Well, thank you guys so much again for joining. And if you have any questions, please let me know. And I will let you guys, when the Learn World site is up and the video is edited, then I will let you guys know when it has been posted.